Those are the only two motivations you can ever have for a covered call or cash secured put. If you recently made or you're thinking about making a covered call or a cash secured put trade, and one of those two things is not your objective for doing it, don't do it because you're going to screw up. You're going to do something wrong. Those are the only two possible objectives you can have, and you better know which one is your objective.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family, welcome to episode 20. Oh my gosh, it's episode 20 already. How did we get to episode 20? Geez Louise, time flies when you're having fun. Before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get that feedback from, that frequency bounce back I like to talk about, the more you grow as a trader. The second thing you can do is to support the show with a paid subscription. For the cost of one fancy Starbucks once a week, you'll get video extra podcasts and posts chronicling my covered call and cash secured put trades with some backstory into why I did the trade that way. And these are trades that I'm making in my real brokerage account. Plus, you'll get access to our monthly Ask Me Anything session and much, much more. To get all this, go to my Substack at wealthbuildingwithoptions.substack.com and subscribe to the monthly or annual subscription. So I decided to start writing this book a couple of months ago, right after I signed the contract and the ink was proverbially dry. I mean, now everybody uses DocuSign, so the ink wasn't really dry, but I don't know, the electrons were dry, I guess. And one of the things that's going really, really well with the book is my level of procrastination. Whew, it is through the roof. You can't even imagine it. I just hope my publishers are not listening to this because they're not going to want to know or hear that I've been procrastinating, but I'm just a little bit behind. So anyway, one of the things that I did to procrastinate is to plan a project to build a garden. My daughter came to me, she's very into plants, and she said, we should plant a garden. I said, that's a great idea. We went out to the garden and I realized that the garden that I built about 5 years ago is all rotted wood. And I'm like, well, let's just build another one. Should only take after we buy the wood, not too long, a couple hours, right? Well, I went online and I looked up one and it looked pretty easy to do, you know? So I went and I thought through all the wood we would need and all the things we would do and the stain and all that business. We went and I bought every single thing we needed at Lowe's. And then got out the drill, got out the saw, boom, boom, boom. We did it with these like modules. There's like 2x2s with some cedar boards going across for the wall and then chicken wire on the top. It's freaking awesome. Raised bed. And you walk into it, there's a door, whole shebang. So yeah, the bases were going to be 4 feet wide on each of these modules. Then you just screw the modules together, right? So 4 feet wide, very, very simple. You cut the cedar boards 4 feet wide, boom, boom, boom. You're done. Screw them onto the 2x2s, done. So the one side has got 3 panels of 4 foot wide modules or whatever they are. No problem. Measure it out. 4 times 3 is 12. Okay. So the 4x4 on the bottom for the base, once it's level, it's got to be 12 feet. No problem. 4 times 3 is 12. So did that, got everything cut, laid out the panels that I built that are 4 feet wide. And guess what? The sons of guns are too big. You know why? Because I didn't think about the darn 2x2s, which are not 2x2, incidentally. They're 1.5 by 1.5. I don't know why they call them 2x2s, but nonetheless, I screwed that up pretty darn good. Each one was, well, let's see, 3 times 3, 9 inches too long. So I had to go back and buy some more 4x4s for the base. Anyway, fixed it. I knew enough to get everything level and square. Got all the bases, measured everything out better this time. Boom, we're done. So I screw on the panels that we made. Oh, and by the way, you know what took the longest is staining it and sealing it. It took freaking forever because there's 2 coats of the sealer, which is after the stain, which is another coat in and of itself. It took forever, and it's freaking linseed oil. Like, you can't get that crap out of your clothes. Anyway, there's a point to this, by the way. So screwed on the panels on the one side. Oh, exactly 12 feet 9 inches. Wham, bam, thank you, ma'am. Great. Then we come along to the back, and all of a sudden I'm screwing them on, and wait a minute, it goes over the edge. I don't even know what I screwed up, but I screwed something up. So you kind of have to rig it up and all that business. I'm still in the process, and it is kind of fun, actually, especially doing a project with my daughter. That's the most fun part of it. And it does kind of look good, even though I screwed it up, and I'm still solving problems that went wrong because stuff is the wrong size. And I don't know. It's the first time I ever did something like this, and I don't have those skills. It was fun to design the garden, to think big picture, to architecture it, look for it online. Oh, how do you do this? Okay, I get it. That's really, really fun. But it really helps to have those background skills of like, hey, when you measure something, you also have to measure the stuff it's screwed into. Like these basic principles turn out to be kind of important. Now, with investing, a lot of times you kind of have to figure out what the best way to trade something is. And I just wrote an article about this on our Substack. And then I list out some of the trades that I made. It's about a trade that I made that I had to figure out the best way to trade it. And I did it. And I put on the covered call, and it's great. Now, I've been doing this stuff for years, right? Like I started in options in 1993. All these skills, knowing you got to measure the board and then the stuff it's screwed into, like I've been there, I've done that. And to be fair, probably if I build another garden like next week, well, actually, this one probably won't be done by next week, but next month, I'm not going to make all those mistakes, right? And if I build like 10 more, I'm going to be pretty good at it. With option trading, all those little nuances, those little skills, those little things that you kind of got to know before you can even start thinking about, hey, how do I make this garden look pretty? How do I make this investment architectured in the smartest way to yield the best profits with the least risk? What's the best way to do it? Without the skills, it's hard. And skills, I don't know, skills really isn't the right word for it. It's not, I mean, it is skills, but it's just little bits of knowledge, little head starts that, like, oh, if you know this, you're in good shape. And these are a lot of the things that we've been talking about in the last couple of episodes. And I kind of want to, I don't want to say recap because, I mean, it is kind of a recap. That is sort of the intent, but it's instead of recap, let's call it reinforce while throwing in some extra stuff while adding some clarity. So, one of the things that I talked about over the last 4 episodes is this sort of, I don't know if I called it this, but sort of a checklist of criteria that you would use when setting up any covered call or cash secured put trade. And it's a list that's pretty tried and true. I actually came up with this for the first time, probably, gosh, man, 8 years ago or something like that. I wrote this little PDF, a couple page PDF, and I called it Nail the Trade. So you would have this little checklist for when you're doing, and that was specifically for covered calls, but it's all the same for cash secured puts too. You would have this little checklist, and as long as you paid attention to each one of these things, you wouldn't screw it up that badly. There could be somewhat better ways to do it, but you're in the right ballpark. That's exactly where we live right now with this podcast. We're at that point where we want to make sure we really, really know this checklist. What are these little steps so that when we start putting together trades, which is what we're going to talk about in, I don't know if it's, I think it's the next episode and or the episode after that. Actually, probably both. About getting a little bit creative and how to do which, when, and all that business. These things, these nail the trade criteria, they're universal, man. They're totally universal. Every single covered call, every single cash secured put, you do these things and you're off to a great start. Each one of them is going to have their own nuances, their own architecture to them, but you do these little things and you're off to a super, super great start. So let's run through this and let me backfill. Okay, we'll keep it the landscaping lingo today. We're going to backfill some information here. So you always want to use stocks or ETFs that are already in your inventory. All right. Yes, we use the word inventory in finance, just stuff that you already own in your portfolio. There are ways to do it for stocks or ETFs that are not in your inventory. Well, I guess specifically with covered calls, they would be in your inventory. With cash secured puts, it would be one that you want in your inventory, right? Because that leads to buying it. And then there's buy rights, which we're going to talk about in either the next episode or the episode after that. I haven't quite mapped all that out yet. But I would say covered calls, which is by definition, by my definition, it's where you already own the stock or ETF and then you sell a call. And by the way, you might be asking yourself, well, why wouldn't I have already sold the call? Well, the characteristics of stocks change, right? Like look at any growth stock. I mean, growth stocks, they take off, they go through the roof and, they're all, this is the hottest stock in the world. And some of them, they just peter out and 2 years later, they're out of business. But some of them, they mature and they level off and their earnings stop growing at like massively high rates. And they're just growing at good corporate rates. And then they're not as volatile. They end up becoming good covered call candidates. I'm sure that I have stocks in my account today that are not good covered call candidates, but maybe a year from now or 2 years or 5 years from now will be. And vice versa. Some might come into the limelight and just have too much volatility or too much velocity upward or downward. Speaking of which, I mentioned the phrase non-volatile, and so that's another part of it, man. Non-volatile. Now, it's all relative, right? And there's different ways to measure non-volatile or volatile for that matter. You can use historical volatility. There's ATR, average true range, that can be used. And many episodes from now, we're going to talk about some great stuff with ATR I've been working on that you're going to love, love, love. It's going to help you trade your covered calls, cash secured puts better, better, better. But we're not there yet. So non-volatile, especially range bound. right? Because even if you want to get assigned, like you never want, like, say you sell a cash secured put. Okay, I want to get assigned. Stock's at 100. I feel for whatever my criteria are, it's a good buy at 85. I sell the 85 put. I want to get assigned at 85. But if the stock just drops like a rock and it's trading 50 and you buy at 85, that kind of blows. Like that really sucks. You can't always prevent this. I mean, these things are going to happen to you. You trade for 30 years, you're going to see that happen. You're going to see lots of things that you never imagined could happen. But you want one that you perceive to be not crazy volatile. Also above $30 a share. Why? Because options trade as a percentage of the stock price. If there's a $7 stock, like here, I'm going to pull this up on my screen. You can't see this because it's just an audio podcast. But let's take my friend, the Ford Motor Company, $10.43 it is today. If you're listening to this live, which you couldn't be unless you're like standing outside my window, because I always pre-record these, or usually anyway. $10.43. If I want to sell a 9-day covered call, that's like a 0.5% out of the money. No, 5% out of the money. Well, let's see here. 1043. If I wanted to sell the 11 strike calls, a little less than 5% out of the money, I could sell them at 2 cents. That doesn't make any sense at all. The only other strike listed, I mean, higher strikes are going to be worse. 0 bid. The other strike is 1050. That's only 7 cents out of the money. That just doesn't make any logical sense at all. And that's only 13 cents. Like it's very, very, very difficult to sell options on stocks that are less than $30. But I do sometimes. And I've wrote articles on my Substack that included AT&T covered calls, which I've actually done for years, even though that one's very, very challenging because it's under $30. But the way I did it and continue to do it makes sense. And hey, again, it's kind of the same thing, right? I know the nuances. I have the rules. I know what to measure and when. Measure twice, cut once. But because I know those things, I can work around within the system and I can change things as long as I know what to look out for, right? So if you keep it above $30 a share, you're in good shape. And this is one, man, I'm not going to say it's controversial because it's not like people are talking about it like pitchforks and torches or anything, but it's one, I guess in my own brain, it's a little bit controversial with myself. Only sell covered calls or cash secured puts if implied volatility is overpriced. And we talked about how to do that in the past. There's the 3 things, right? Implied is above historical, implied is in the top half of the 6-month range, and don't expect implied or historical to rise during the life of the option. It's a good idea to sell if implied volatility is overpriced because you get an edge, which we'll talk about a little bit more shortly. But it's not 100% necessary. And we're going to talk several episodes from now about passive and active covered call trading. And that has a lot to do with that conversation. If I don't have the next episode scripted out yet or outlined out yet, how do I know we're going to talk about this in a few episodes from now? Well, it's because everything that I talk about in this podcast is based on what I'm writing in the book about the wheel. And in chapter 8, this is exactly what I'm talking about. Active and passive trading of the wheel. That's a section anyway. So we prefer if implied volatility is overpriced, but sometimes if it's not, it can still be okay. We want to avoid earnings. That's another one that is not a hard, fast rule, but is something you should always be thinking about. If earnings is coming up, you ought to think, hey, do I really want to have on a covered call or cash cured put if earnings is coming up? And sometimes I'll take them off and sometimes I won't. And it's not just earnings, it's any widely expected potential volatility event. For example, every year, Apple hosts the WWDC, Worldwide Developers Conference. And if you are a big nerd like me and you say, oh, well, okay, it's coming up on these days, let's go back over the last 10 years and see what dates it was on over the last 10 years. And let's see what Apple stock did during that period, because I actually did that. And I saw that sometimes the WWDC is a big deal and can lead to the stock really taking off higher. And then there's sometimes when it actually went down. And then there's sometimes when it didn't really do anything. But just this time around, they had it. And I took off my call portion of it. I kept the stock on, took off the call portion of it because overall they tend to go up during that conference. And it turned out to be a nothing. And afterwards, I ended up writing another call. But we do want to avoid volatility events if we can. Okay, the next thing, bid ask spread should comply with the 10% rule. What is the 10% rule? We talked about the 10% rule. You know what the 10% rule is. Wait, don't tell me. Okay, I'm going to tell you. Unfortunately, this is a monologue, not a dialogue. I kind of have to tell you. Okay, so 10% rule is when the offer is less than 10% greater than the bid. Then you're in compliance and it complies with the 10% rule and it's a positive for the trade. Okay, what exactly does that mean again? Okay, well, let's say that you're looking at an option, you're thinking about selling it as covered call or cash cured put, or really any option trade for that matter. And it's $1 bid. What's the offer? Well, what's 10% more than a dollar? Well, it's $1.10, isn't it? Okay. So as long as the offer is less than $1.10 or $1.10 or less, I guess, you're in compliance. If it's more than $1.10, it's just too wide. And you don't want to just look at that one option because that one option could be tight and everything else could be wide. So you want to do a little smattering. Just look at the first three expirations of the 3 or 4 options closest to the money of both calls and puts. Are they all in compliance? It'll take you about 15 seconds to eyeball it, especially once you have some practice with it. But you want to be trading tight markets because if it's hard to get in, it's going to be really hard to get out. And I don't know why, but it always feels like it's harder to get out. Maybe because it's closer to expiration and the market makers know you're trying to get out. I don't know, but it's always harder to get out, it seems. Next criterion, that it makes sense to your overall plan. Why are you trading covered calls or cash cured puts? Well, either to skate and get the money or to trade into or out of the stock. That's it. There's only 2 reasons for a covered calls or cash cured put. Try to skate, which means not get assigned, keep the money, and woohoo, I stole some money from the market. Or trade out of the stock that you're in by your covered call getting assigned or into a stock that you want to get in by your put getting assigned. Those are the only 2 motivations you can ever have for a covered call or cash cured put. If you recently made or you're thinking about making a covered call or a cash cured put trade, and one of those 2 things is not your objective for doing it, don't do it because you're going to screw up. You're going to do something wrong. Those are the only 2 possible objectives you can have, and you better know which one is your objective. So does it make sense to your overall plan? I've got this stock. This stock has been good to me. It pays a great dividend. It's been really climbing lately. I'm going to sell a covered call on it. Does that benefit you getting assigned and losing a stock that's been steadily climbing that pays a good dividend? Does it benefit you? I mean, it might if the dividend yield, dividend yield, you know what? Gosh, that's something that I look at for covered calls too. which I don't know if I have slated for the book. I love it. I love this. See, this is actually why I decided to do the podcast and the Substack along with the book, because I figured that just talking about it and writing about it and interacting on Substack about it with people, that it would just generate more ideas for me. I would think about something and it just happened. My evil plan is working out just as it's supposed to. So dividend yield, yeah. Like maybe you have and by the way, that is one of the rationales for me trading AT&T. When it was lower, I sold cash cured puts to get into it because it had a good dividend yield. Now the dividend yield is not so attractive anymore because the stock's higher. If it pays the same dividend, but you have to pay more for the stock price, the yield you're getting from those dividends is lower. That's my whole big trick for AT&T stock. It's kind of all about the dividend yield for me. Sell cash cured puts to get in when I can buy that same cash flow of dividends for a cheaper stock price, and sell covered calls to sell out of that stock when it's not as good a dividend yield. And it's been pretty good. Whatever the rationale is, and man, all working within the skater trade objective system, there can be a whole bunch of little sub rationales for covered calls or cash cured puts, but they got to make sense for your overall plan. And then there's the strike proximity business. The strike proximity also really needs to make sense too. And we did talk a bit about this, and if I'm not mistaken, we have a video extra on that for the paid subscribers. The premium benefit analysis, it's basically using your theta, okay? And using theta to say, okay, this is a good candidate for a covered call based on the criteria that I just gave you. Stock or ETF in inventory, non-volatile, over 30 bucks. IV is overpriced, avoiding earnings, bid-ask spread meets 10% rule, fits into my overall plan. Okay, great. This is a good covered call candidate, I think. So which one of these do I do? Well, I could do this strike, or I could do a higher strike. I could do this expiration, or I could do a different expiration, shorter term, longer term. I know that closer to the money, I get higher theta, more premium. Closer to expiration, if it's close to the money, I get bigger theta. It decays at a faster rate. And so I compare thetas in order to optimize which option I'm going to trade. And it's important to do that. You can't just say, oh, I'm going to trade a covered call. I'm going to hack through it. Oh, yeah. Okay. Well, I'm going to trade a covered call. How about this one? Yeah, that looks good enough. All right. Sold. That's not how you do it. Because I'm going to tell you something. I'm going to tell you something right now. I always tell you like it is. Folks who are my market taker mentoring long-term students, you know that. I tell you like it is. And trading and investing, it's hard. I mean, it's fun. And you're right sometimes and you're wrong sometimes. And it can be emotionally satisfying because you get that emotional. It's not a roller coaster. If it's a roller coaster, you're a little too emotionally invested, but emotional dynamics. It's fun and it gets easier the more you learn. And it's a good mental thing. I once, at one of my market making jobs, one of the owners of the firm, real super nice guy. I was chatting with him one day. It was his money I was trading. I was chatting with him one day and we were just talking about stuff, nothing important, philosophy of trading, I guess. He's like, I always thought of options as mental masturbation. It's like, yeah, well, all right. Yeah, I can see that, man. You're always, you're always thinking about it. You're always, well, never mind. I don't want to go down that route. I already went too far. This is a family show, kind of. Anyway, so, you always need to sort of massage these options because you have winners and losers. If all your winners are okay, and you win at an okay rate, this probably isn't going to work. You got to really maximize those winners, make them set up to be as good as they can possibly be, where you make the most and lose the least and increase your chances of winning or a bigger premium. If you don't maximize them every time, you're not going to win. Like race car drivers or something. I'm not a race car driver or anything like that, but I mean, they don't just say, "Oh, well, I guess I'll get in a car and I'll drive fast." No, they have all these little nuances where, the tires are this exact way, and they put the fluid in the thing that makes it go faster. And, there's all these little things that make a big difference. They say little hinges swing big doors, and they do, especially with trading. So you really need to optimize this and use your theta to compare different choices for covered calls or cash geared puts and make that best choice. And we talked in a previous episode about daily theta versus aggregate theta. And man, I'll tell you what, I think that that's a great way to look at it. Daily theta is just the number you look at when you look at theta, and it wouldn't be there if it wasn't massively useful. But then there's also aggregate theta, which is, I don't know, I'm sure other people look at it this way, but I just kind of came up with it in my brain. I'm sure somebody else came up with the same idea because it just really resonates. I think it makes a lot of sense. Where if you're deciding between like a 7-day option, a 14-day option, and a 21-day option, well, just take each one of those choices and divide the option premium by 7 days because it's all multiple 7 days, right? Well, the first one, just 7 divided by 1, it's whatever the price of the option is. The other one is 14 divided by 7, so that's 2 chunks of it. And the other one's 21 divided by 7, that's 3 chunks of it. And if 1 week passes, which 7-day chunk is better for you? Does that make sense? It should. I mean, we talked about it before. This is, that refresher and reinforcement episode here today, right? Like if the 7-day option is $1 and the 14-day option is $1.80 and the 21-day option is $2.40, well, which one makes the most money in a week? Well, the 7-day one, you make $1. The 14-day one, you make, well, what did I say? $1.80 divided by 2, 90 cents. So that's not better. The 21-day one, it's 240, right? So 240 divided by 3, you make 80 cents. Oh, well, it probably makes sense to sell the 1 week one and then sell another 1 week one and then another 1 week one. And then you're going to make 4 in those 7-day chunks of aggregate theta. And you make more in 3 weeks selling the 1 week ones than selling 1 3-week one. Sometimes 1 times 3 is greater than 3 times 1, at least when it comes to aggregate theta. And so the whole point of all of this that we just talked about here, I felt it was really super important to make sure you like abso-darn-lutely, totally 100% and then some really, really get this. Really get these steps. You get these steps, and man, when you're deciding how to build it, your trade, you've got all the skills, you've got all the best practices. And then you can think a little bit out of the box. As long as you know what's in the box, you can think a little bit out of the box. I think I said this on an episode before. Maybe I wrote it in the book, or I don't know, maybe I was just talking about it with somebody, but there's that saying for artists, like you have to know the rules before you can break them. And you don't have to know the rules before you can break them, but if you want to be a good artist, you probably ought to. That's the thing about being an adult, right? Like when you're a kid, you got to follow all these rules. As an adult, you don't have to follow any rules. But turns out there's rules for a reason. They benefit you. You follow these rules and you're way better up. You got a massive head start above everybody else who didn't follow these rules. So that, friends, is everything that I had to say today. I would really, really appreciate if you would leave a review. If you leave a review, that does a couple of things. First of all, it helps Spotify and Apple and all the podcast platforms out there. It lets them know that somebody cares. They're interacting. People are interested enough to leave a review. So that really, really helps our show get shown to more people on those platforms so that we can grow this community. And that, friends, is so important to me. We don't run ads on this podcast. You notice that, right? And I have absolutely no plans to do so in the near future, and realistically, probably ever. I like doing this. I mean, it takes a lot of time, but I like doing it. It's a passion for me, and it really, really, really gets me excited to grow this as a community, because that helps you. It helps me solidify my ideas. It really helps everybody. So please leave a review. And if you do leave a review, take a screenshot of it and post it on Substack. And we are going to send you a special gift. And that about wraps it up for this show. Next week, we have episode 21. Be there. We drop these every Tuesday morning. I will see you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.